Most investors overcomplicate things, but in my experience, it's a few simple rules that make a world of difference. Today, I'm breaking down 3 rules that completely change how I invest, and they're still rules I use today. And stick around till the end, because the third rule is the one I see most investors get wrong, and it costs them millions in missed gains over time. These rules aren't just ideas, they're backed by data, real-world examples, and lessons learned through wins and mistakes. If you can apply them, they can completely change your approach to investing. The first rule, Rule 1, only buy businesses you truly understand. If you can't explain how a business makes money in 30 seconds, you shouldn't own it. When you understand a business, you make smarter buy and sell decisions, and you're less likely to panic on any dips. You know where the revenue is coming from, what drives profits, and how the company reacts to competition. That clarity lets you focus on the long-term picture instead of the short-term noise. For me, one of my biggest positions is Amazon. I actually just made a deep dive about them. You click the box in the corner to watch that video. But I can explain how Amazon's AWS and e-commerce makes money. AWS generates high margin revenue from cloud computing, while e-commerce drives massive product volume. I know how each part makes money and how they fit together. But a biotech drugs pipeline, I can't confidently evaluate regulatory risks, trial timelines, or product demand, so I don't touch it. This is important because if you don't know where the money is coming from, you can't evaluate risks, competitive threats, or growth potential. And when bad news hits, you're more likely to panic sell. A study from Dalbar on investor behavior showed that emotional reactions to the unknown led to chronic underperformance, and not understanding a business is one of the fastest ways to trigger those emotions. The fix, stick to companies you could truly break down. If you have to open up a 50-page PDF to understand what they're doing, it's probably not for you. Keep your circle of competence small but strong. Over time, that circle can expand as you learn new industries. But even if you only buy companies you understand, you still need to think about time horizon, because that changes everything. For rule number 2, we have think in decades, not days. Short-term market noise can wreck your gains if you let it. The best gains come from holding great companies for years, even decades. Look at a 20-year chart of Apple or Microsoft. Both companies went through recessions, market crashes, and leadership changes. But long-term investors saw incredible compounding. 10K invested in Apple in 2003 would be over $1 million today. Compounding works like magic when you give it time. Albert Einstein even called it the 8th wonder of the world. But if you're constantly buying and selling on short-term noise, you're resetting that compounding clock over and over again. Market history shows that in nearly every 20-year period, staying invested has beaten trying to time the market. JP Morgan found that missing the market's 10 best days each decade can cut your returns in half. And those days often come right after the worst days. The fix, before you buy, ask yourself, would I be happy holding this company for 10 years? If the answer is no, skip it. Build a watch list of companies you'd be comfortable owning through recessions, political changes, and industry shifts. Of course, even when you're thinking long-term, there is one rule that will decide if you're actually going to make money or just break even. Now into rule number 3, price matters, but quality matters more. You could buy a cheap company and still lose money if it's a bad business, and you could pay a fair price for a great business and watch it grow for years. An example is ASML at 30x earnings is still the world leader in EUV lithography. This is a critical technology that every AI chip needs. Compare that to a dying retailer at 5x earnings. Sure, the retailer is cheaper, but it might not even be around in 10 years. The data is clear. McKinsey research shows that companies with high returns on invested capital tend to outperform the market, even when bought at higher valuations. This is because quality companies generate more cash from each dollar invested, allowing them to reinvest and grow faster. Value traps often look attractive on paper. Low price to earnings ratio, high dividend yield, but without growth or competitive advantages, they're dead money. On the other hand, high quality companies can grow into their valuation and deliver decades of returns. The fix, don't just ask if it's cheap, ask if it's worth it. Look at profitability, competitive moats, and management's capital allocation decisions. Quality companies can survive downturns, innovate, and expand. Bad companies can't grow out of their problems. These 3 rules have shaped every investment I make. They keep my strategy simple, my portfolio strong, and my emotions in check. If you follow them, you'll be ahead of most investors out there. And the best part is, you don't have to get every pick right. You just have to avoid big mistakes and let your winners run. This is a reminder, this is not financial advice. These are the rules that I follow and I have found have been very helpful. Before buying any stock, you should always do your own research. Which of these rules do you follow, and which of them do you need to start following? Let me know in the comments. Thank you for watching, and I hope to see you back in the next one.